Computer. Righty, recording is in progress. Welcome to week 8 of the Rebel Finance Recap, which is how to start investing. So we've talked about a whole bunch of other stuff so far, but I do have to come up with a disclaimer. We are not financial advisors. That's the royal we of basically anybody in the Facebook group. Well, I think we have a couple of financial advisors in there, but they're not giving any advice under financial advice. But Alan, Katie, myself, any of the other Rebel Ninjas, we're not financial advisors. We do not give financial advice. It's not regulated. It's all to do with our opinions and what we've learned, how we view things and all that sort of stuff. And everything that we've done so far might not continue working. So what is most important is that you do your own research and that you understand that the decisions are your own. Okay, if you want to put the decisions onto a financial advisor, by all means get advice from a financial advisor. The best tip I can give you around that is to get your free hour with most financial advisors and maybe shop around half a dozen different financial advisors and get half a dozen hours of free advice. Obviously, if you sign up with a financial advisor, you are going to pay fees. And in previous weeks, we've seen the effect that fees can have on your investments over time. So it's worthwhile if you want the guarantees of various sort of financial security things, but it doesn't guarantee your investments will go up. What it guarantees is that if they do go up, and even if they go down, you will not get as much money back at the end of the day because it goes in fees. So one thing before we talk about investments that you really need to take on board is that investments can and will, most definitely will, go down in value as well as up. And one of the best things to do when investments go down in value is to hop onto YouTube and Google J.L. Collins meditation for when the markets go down and have a good listen to that. So there we go. Now, before we start this, absolutely, we are not sponsored by Vanguard in any way, shape or form. Okay, we do not get commission. Alan had put on there, I wish we get commission. Actually, no, they don't, because they don't need it. This is the whole thing behind Alan and Katie's lifestyle, is they have managed to reach financial independence. So they don't need to earn money. They don't need to post affiliate links. They don't need to get any more income from you, which is why, you know, what they share with you and what I'm sharing with you is totally free of any strings at all and unbiased. I mean, that's the other thing. If you go to a financial advisor, chances are they get better rates from various people. If you go on Go Compare to look for different things, they will highlight to you the people who pay them the most commission for referring. So yeah. So why support Vanguard? Well, because Vanguard is owned by the people who put their investments into it. It's not owned by any external shareholders at all. So they don't have to give out their money to anybody else. I learned something very interesting today off a podcast I was listening to. The water companies, as you probably know in the UK, are now privatized. Since they've been privatized, they have paid out over £72 billion to shareholders and in bonuses. Okay, that's £72 billion, which if it was still a public utility could have been spent on infrastructure and all that sort of stuff, or helping support people who couldn't pay their bills and all those sorts of things. So it's an interesting thing. They thought it would be run better as a private entity, but I mean, the thing is, you've got to say, well, if you're going to extract £72 billion, they've got to make cuts somewhere. But there we go. So Vanguard, owned by the people who basically put their money into it and by the employees. They have super low fees, which means that you get to keep more of your money. And the founder's mission was basically to help people to become more financially independent. So a quick look back at week 6, which was actually, it should have been week 7, which was last week. So essentially, assets and the things we looked at there. Assets are things that you buy which can give you a return. So they give you income. So equities or property. Now, in terms of property, that isn't the property you live in. The property you live in is not an asset. Why do I say that? Because the property you live in costs you money. It does not generate an income for you. Unless you've got an annex that you can Airbnb, or you rent out a room or something like that. In that case, it's partially an asset, but does it produce more of an income for you than it costs you? Commodities, bonds, and cash in savings accounts. Finally, the only good thing to come out of the current inflation and interest rates thing is you can finally stick your cash into an account that will pay you a rate of interest. And in fact, I think I've seen that there's a couple of banks out there now offering regular saver rates of up to, I think, about 7%, which, you know, isn't bad. I think the maximum they let you put in is about £200 to £300 a month. So you are limited on the amount of interest that you can earn over the period of year. And the thing to remember if you do go for one of those is that after a year, they generally cut the interest rates quite a lot. So you then need to find your next best sort of deal. We looked at stocks and shares and equities, which are essentially three ways of calling the same thing. Excuse me. And what else did we do? Oh, time. It is time in the market, not timing the market. So the question comes up time and time again. I've got a lump sum of money. Should I just stick it all in, or should I just trickle it in? The answer is, mathematically, over 75% of the time, you are better off just sticking it in and leaving it there, for as long as possible. Now, those of us who are more mature, like myself, who is now 49, I appreciate we have more mature people than that. And you go, well, you know, I'm close to retirement and all that sort of thing. The thing is, well, yes, you might be, but are you planning on pegging it when you hit retirement age? If you're not, if you're planning on living for another 20, 30 years, you still have that amount of time for your investments to grow. So it's well worth sort of doing it, no matter what age you are. Obviously, the earlier the better. So the best time was like when you were 18, and the second best time is now. So just get on and do it. Don't be a never bothered Ned. However, if you have not got all of your other ducks in a row, if you have debt, pay it off first. If you have not got an emergency fund, create an emergency fund first. If you haven't got those two fundamental things done first, please do not invest yet, okay? Get those two milestones done, then it's time to look at investing. Okie dokie. So some questions that came up on the Facebook group and were being asked as to how are these things structured? You know, should I get this SIP or an index thingamajig and all that sort of stuff? Should I put my money in the ISA or do the Vanguard thing? So, you know, there's, you know, do I put my pension in the Vanguard? I'd like to kind of look at how these things are structured now, because it's kind of like a little nesting thing, you know, the sort of Russian dolls. Ooh, we're allowed to talk about Russian dolls. You know, these little things that stack inside each other. That's kind of how all of this is structured. So let's have a look at the different levels of thinking. Your big doll on the outside that holds everything is your provider or your platform. So this might be Vanguard, it might be Interactive Investor, it might be Hargreaves Lansdowne, it might be Lloyds, NatWest, you know, another bank building society, or another person like that. So basically, this is a financial institution where they will offer to you SIPs, ISAs, LISAs, all those sorts of things. So in the UK, there's a list of people. In the US, there's a whole bunch of people. Okay, so those are your providers, your platforms. Those are the people you will give your money to sort of put it into the wrapper. So then we have what I would call a wrapper, which is your account type. So the choices for these are an ISA or a Roth in the US. So these are tax-free vehicles to put money into. For pension sides of things, if you're doing your pension yourself, it's called a SIP, which is self-invested personal pension, which is in the UK. If you're with a company, they might just call it a pension. Or if with the government or armed forces or whoever, they'll just call it a pension. In the US, you've got your 401k and your IRA, which are two different types of pensions that they have out there. And then finally, we have what's called a trading account, or a GIA, a general investment account. That has no tax benefits at all whatsoever. It is just somewhere that you can put your money that you can then trade it if you've already used up your allowances in the other sort of types of accounts. So those are your account types. And then within the account type, you then have the choice of funds that you can put your money into. Now, if you go into, actually, no, I've got this on another slide, so I won't say it now. But basically, within there, you have providers like Vanguard. Now, whilst Vanguard are also a platform and a provider, they also are a fund manager. So they have their own funds. Now, NatWest and Halifax and various other providers also provide their own funds. And it may well be that within your pension that your company has set up for you, you cannot get a Vanguard fund. However, the Vanguard funds are generally based on what's called a standard. So for example, the Global All Cap, which is the one that Alan and Katie and myself mostly use, is based on the FTSE Global All Cap index. So it may well be that your pension provider, whilst they might not have Vanguard, they have another fund which is based on the FTSE Global All Cap index, or another such index, like based on the S&P 500 index and those sorts of things. So yes, so they will, what you are looking for is a fund which, when you look at what it is rated against, it has the word index in it. And the other thing you want to make sure is that whichever fund it is generally has at least 450 to 500 different companies that it's invested in. So other funds, yeah, Fidelity, Lloyd's. And again, these people offer all sorts of things, all the way from index funds to managed funds. And we've already mentioned managed funds, but basically, yeah, personally, I'm staying away from managed funds now, as you'd have seen in my last video. I do have some managed funds. I do have some individually picked stocks, and they've done awfully. My Vanguard fund, on the other hand, has done okay, especially considering everything that's happened. So what we need to think about now is, in terms of account type, as I've shown there, we've got 3 different types of account, and they differ based on the tax implications around them. So I'm going to just look at UK tax at the moment, because that's kind of what I know most about. So we have ISAs, which you can have your stocks and shares in. You have a pension, and with pensions, these are split into defined benefit, which is what comes out of it. Now, if you're lucky enough to have been in some of the very early pension schemes for companies, you might have defined benefit. And if you're lucky enough to be employed in the public sector, you might be lucky enough to have a defined benefit pension. And basically that tells you how much you're going to get paid out. And these things are generally pretty good, because you know what you're going to get paid. Whereas defined contribution, which is what the majority of pensions are based on nowadays, is how much you're putting into it. So you know what you put into it. At the end of the day, you've got no idea what you're going to get out of it. You just hope it's going to be good. So SIP, which is the self-invested personal pension, which is you doing it yourself. So you might have a company pension, but you want to do a bit extra into a pension. And you can do that through what's called a SIP. And then we have the taxable account, GIA. So the good news in the UK is that in the budget announcement, they gave us a couple of different improvements, shall we say. One is they've removed the lifetime allowance on pensions. Now, what does that mean? Basically, they had a limit of your pension being worth about 1.23 million, I think it was. And if you went above that, then when you took money out of it, they would tax you at a horrendously high rate. I think it was about 50% plus. But they've now got rid of that. So you can save as much as you like into your pension. And when you withdraw, you will just get taxed at your standard income tax rates, which is good. That is an improvement. The other thing to note, though, is that with your pension, you can generally withdraw 25% of your tax amount, of your pension amount tax-free. So you can take out 25% tax-free. What they have done, very cheekily, I think, or actually maybe quite good, is they have pegged that to the current lifetime allowance value. So you can take out 25% of 1.2 million tax-free, and after that you pay tax on it. Now, the other thing they have said is that post 2023, that amount will increase by, I think, the consumer price index or something like that. So every year you will be able to take out slightly more tax-free. You know, this is based on the idea that you've got more than 1.2 million in your pension anyway. Okay, which would be nice to have. Now, here we come to the other thing that they've done is they have now increased in the next tax year. So from the 5th of April, so for 2023-24, they have increased the allowance that you're allowed to put into your pension from £40,000 to £60,000. So if you are lucky enough to earn shed loads of money, which most of their friends are who work in the government, so maybe this policy helps them out, certainly, and not so much the middle income earners and everybody else generally. But, you know, hey, you know, got to be perks for the boys, hey. Sorry, I'm a bit jaded with our government, but there we go. But yes, if you are fortunate enough to be able to put £40,000 to £60,000 aside a year, you can now put even more into your pension as of the 5th of April. So thank you. And also, I believe, I need to double check, but I believe that that is also going to increase year on year by the consumer price index or inflation rate or whatever they've decided to peg it against, which is going to be good. Oh, excuse me. Right. So what's the next slide all about? This is about how tax works. So pensions, you can have your employer contribution, which goes in, and that goes in pre-tax. Okay. So you don't pay any tax, or your employer doesn't pay any tax on what is going into the pension. However, you do pay tax when it comes out the other end. So when you are withdrawing your pension, then you pay income tax on it. The same goes for a SIP, is that you will pay tax as you draw it down. Okay, so if you take out money from your pension after you're 25% tax-free, if you withdraw money from that pension and it keeps you in the lower rate tax bracket, then you will only pay the low rate of tax, etc. Same as if you were earning money. So your pension is essentially like wages, but you're paying yourself from what you've invested. Your ISA, on the other hand, you pay tax before you put the money into the ISA. So you get your money from your wages, or from your salary, or if you've got a very kind friend who likes to give you money, then hey, that's good. But they will have paid tax on it, probably. So taxes come off the money before it goes into your ISA, which means that when you withdraw the money from the ISA. It doesn't matter how much your ISA has increased by, you do not pay any tax when you take it out of your ISA. So what's quite a good thing to do when you reach the point when you want to start drawing down is, if you can withdraw from your pension and your ISA, and you balance it out over the year to keep yourself in the lower rate tax bracket, you can help minimize the amount of tax you have to pay. So it's spreadsheet time. I don't think Katie's made one to do that yet, because they haven't they haven't put in anything yet. Oh, I have just seen the allowance for non-earners. Has that increased too? Yes, that was I think that's the third thing that they have increased, because at the moment you can only put in an extra 4,000 into your pension every year. And the same thing is, if you're drawing down from your pension, you can only put an extra 4,000 into it. However, as of the 5th of April, they have increased that to, I believe, 10,000. So you'd be able to put 10,000 in there, which also means that if you have somebody who is not earning, so if you have a child who is below the age of 18, you can put up to 10 grand a year into a pension for them. And that is, that's perfectly allowable, and they will get the tax credit. Don't forget that that limit is also based on the government giving 20% back. So you wouldn't put 10,000 in, you'd only put 80% of that in, and then the government would top it up with the other 20%. So well worthwhile. And if you can do it for a young person, that's brilliant, because with the graphs we looked at last week, they, obviously compounding over the years until they're, well, I mean, that's the other question, is how are the government going to change the, how are they going to change the age at which you can withdraw from? Because obviously the government gives, you can get your public pension from the age of 65 at the moment, increasing to 67 and then to 69. And your SIP, you can withdraw starting 10 years before that. But every time the government pushes back the public sector, your public pension, that also pushes back when you can start withdrawing from your personal pension as well. So I wouldn't be surprised if they start pushing that age back further and further. So if you are younger than probably about 45, you do need to make sure, if you want to retire early, that you are putting money into your ISA as well as into your SIP, because there's every probability that by the time a 30-year-old gets to withdraw from their SIP, that you're going to have to be at least 70. So yeah, so I would make sure you keep an eye on those sorts of things. Then we have our general investment account, and as I said, you get taxed both ways on that, so both incoming and outgoing. So yeah, so on the pension, I don't know why my text has gone black on the slide, because it should say pension and then the details on it. So the other good thing with a pension from a company, and why you might consider using them even if they don't offer you brilliant options in terms of funds that you can put money into, is, at least in the UK, your employer has to make pension contributions for you unless you've opted out. And generally they will match whatever you are putting in, and maybe a little bit more, up to a certain percentage. And now, in some senses, that is free money. So even if the chart fees are higher, and even if the funds aren't quite so good, it is worth checking out and making the most of the employer contributions. What is also worth checking out with for the employer's sort of pension is, are you able to move the money from that pension to your own SIP on a 6-month or an annual basis, so that you can have more control over it, or aren't you? Because there are some employer pensions helpfully, you know, that organisation who was set up by the government so that everybody would get an employer pension. However, the caveat with that is that as long as you stay with that employer, you cannot move the funds from that pension fund into your own pension fund. So you are stuck with whatever they offer, which, whilst not brilliant, it's better than nothing. So absolutely keep an eye on it. The ISAs currently have a £20,000 annual limit. Now, I believe, and I've forgotten, I meant to double check this today, but I believe that they've said that as of next year, they are going to start increasing the ISA annual limit also by inflation, or the consumer price index, or whatever index they're going to use to increase it. So that will be quite nice as well. Now, you can only open one ISA per year, and you can only pay into one type of ISA per year. Okay, so you can have, there are several different types of ISA. There's a cash ISA, a stocks and shares ISA. You can have your LISA if you're lucky enough to be under 40. Over 18 and under 40, you can have this thing called a LISA, which is a lifetime ISA, which you can use. It either works as like a pension, or it works so that you can take the money out of it and put it as a deposit against your first house, as long as you get a mortgage on your first house, and as long as the house is not over a certain value. And the value varies depending whether or not you're in London. Okay, so a LISA is awesome. I really like them. But if you're planning on using it for a house deposit, you do need to check out the sort of caveats around that. However, I still think they're really worthwhile having, especially for the younger people, because if you remember, I said about that, the balance of tax to keep you below, you know, to keep you in that basic income tax bracket when you come to retire. Another way to balance that out is to have a LISA, which is tax-free whenever you withdraw from it. So if you're withdrawing from that as part of your pension, if you like, as well as your pension, you can use that to help keep you in the basic rate tax bracket. Let that one sink in. And then, yeah, there's being taxed both ends on the general investment account. Now, one thing I should say about a general investment account is if you have used up all of your ISA, and if you have used up all of your SIP and pension allowances, it is still worth considering a general investment account so that you can put the money in there to be growing over the year. Because certainly in the UK, we have a capital gains tax allowance, which means that you can make tax-free a certain amount of money in the general investment account every year. And then what you can do is at the end of the year, sell off some of the stuff that's in your general investment account and transfer it across to your ISA or your pension, and, you know, make some of the gains tax-free. So still well worth looking at. Which should we invest in first? Well, the one that gives you a fabulous amount of money is the pension, because you instantly get a 20% boost on that. So you instantly get your tax back on the pension. So your SIP or your company pension contribution, you get that extra deposited, and that obviously then goes in earlier and it gets to compound. So even if you end up paying tax when it's coming out, you know, this extra that you've had to start with would have more than grown, we're hoping, to cover the tax when it comes out the other end. So that's a good thing. So the SIPs, company pensions, then your ISA, and your ISA, your LISA, those sorts of things. But as I've said, the caveat there is to take the age that you are aiming to fire and make sure that you will have sufficient in your ISA pot to do that, because you can't draw out of your SIP or your pension until a certain age. When doing your net worth, though, you take all of these into account, your pension and your ISA, because they're all one whole pot of money. Now, we've talked about the 4% rule, which is how much you're going to draw down from the investments that you have. But it may be, say you've got half of your money in your SIP and half of your money in your ISA, you're only 45 and you want to fire, you want to sort of relax, that's fine. You can withdraw 8% from your ISA on the basis that you're actually going to empty or, you know, take a lot of money out of your ISA account, but your pension will still be there. So your overall pot size, you will only be taking out 4%. However, but the thing is, you'll be taking 8% out of your ISA because you can access your ISA. So hopefully that makes sense. That's only if you've got it evenly split 50-50 between the ISA and the pension. If you've got different levels, then you need to work out the different percentages. There are some drawdown calculators on the web. So if anybody wants to find one, you can Google them, or if you want me to find one for you, then give me a shout in the Facebook group and I will find one and post a link to it. Okay. And then, yeah, finally use the general investment account. And yeah, that was a slide that had a lot of useful text on it, but you can't see it because for some reason it's decided the text is going to be black. It wasn't black when I made it, so I don't know what PowerPoint's doing, but there we go. It's a lovely picture of a baby. But basically it was, you know, should I put all my money in my pension, or I'm planning on retiring early, should I use a pension? And the answer is yes, 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 please do, because, you know, you get this extra money back from the government, or at least you don't have to pay tax on the money that's going in there. So absolutely use a pension, but also work out what you need in your ISA. Should you have a cash ISA and a stocks and shares ISA? Good question. Now, I don't have a cash ISA. I only have a stocks and shares ISA. You could use a cash ISA if, say, you wanted to hold your emergency fund in it. If you've not used up all of your ISA allowance and you've got some cash, you could put your emergency fund into the cash ISA, as long as it's a flexible ISA whereby you can draw it back down should you need it. Now, the reason you might want to do this is so that you use as much of your ISA allowance every year as possible. Okay, it might be you're only using 5,000 or 6,000 or 10 or 15,000. But the thing is, every year, every April the 4th at midnight, any allowance that you have not used on your ISA, you lose. It is a use it or lose it situation. You do not get to top it up again from the previous year's money if you suddenly get extra money in. So that could be one reason for using a cash ISA is just to keep that money there, to stick it into the ISA to boost that level, because then if you do have a bumper year where you have more than the ISA allowance, what you could do is that cash that you've got in your ISA, you can transfer it across from your cash ISA to your stocks and shares ISA. That is allowed. You can transfer between different types of ISAs, which means that you could then turn that cash that you were holding there into stocks and shares, as long as you still have enough reserves to be, you know, to have an emergency fund, which you might then hold in premium bonds or in an instant access account or something. So that's why you might have both. So there we go. Oh, look at that. This time it's decided it has kept the fonts so that you can actually read them. But I think at least I remembered everything that was on there. So yes, it's one of those things. You need to work it out for yourself as to what works for you. The other thing is, I mean, to be fair, cash ISAs, the rates of interest you get off them are not brilliant. You can get better off a standard savings account at the moment. But as I say, it really is based around the idea of, is it possible that in the next year or few years, are you going to reach a point where you actually have more money than is available in the allowance. If it is, then if you've used up, if you've been able to put some extra into a cash ISA, then you can transfer it across. If that needs clarification, which it may be because I possibly didn't do the best explanation of it, any more help you might want with that, I'm happy to pick up on it later. But be careful. Why have we got to be careful? Good question. We've got to be careful because PowerPoint has changed the text back to black again, and I have no idea. But be careful. Yes. Do your research and be careful. There we go. Vanguard. Yes, lovely. You can buy Vanguard funds across various platforms. We like Vanguard. They were one of the original sort of index fund providers. Most importantly, they are one of the lowest fee providers. Ideally, you might be able to buy them. If I was starting again, I would go with a Vanguard account and I would buy Vanguard funds. The reason I would do that is so that I am not tempted to wander off trying to design my own strategy, thinking I can be clever and that I can beat the markets. And I would be quite a few £1,000s better off had I stuck with that. So yeah, hindsight is a wonderful 2020 thing. And I personally, knowing what I know now, I would not hesitate to open a Vanguard account and use that for my SIP and my ISA and everything. The only thing to note with Vanguard is if you work for a company, they cannot put money into your SIP. Okay, so if you work for a company, if you are employed by a company, your employer cannot currently put money into your Vanguard SIP. If you run your own business, then you can put money into your Vanguard SIP, but you have to be a director of the company. Okay. If you want to use Vanguard funds and you are employed by somebody, but you still want to run your own SIP and you want them to put money into it, then you can use Hargreaves Lansdown or Interactive Investor, or I think AJ Bell as well, and any number of various different ones. Then they can put into your SIP directly. But you need to be careful and make sure you still get an employer contribution and any top-ups and any bonuses that the employer might offer as well. If you are putting money into Vanguard or any other organization which has the FCA, the Financial Conduct Authority agreement coverage, then you do have that compensation cover should anything go wrong with them. Now, the thing to be careful with is that so many different brand names are actually owned under one parent company, that you might find that even though you've got 3 accounts with what you think are 3 different organizations, because they're under the one parent company, you still only get one amount of financial compensation cover. So it's worth looking into who the parent companies are if you've got more than 85,000 with one organization. I would say with someone, well, with Vanguard and with some of the other people, as long as they're straight up, well, Vanguard, I would say is a no-brainer. They are, I don't feel there is any way Vanguard could ever disappear, because they don't have shareholders, because of the way they're structured, and because of the way they're managed. I don't see a way that they could fail. They're not leveraged with debt. You know, the way they structure their client accounts and their company accounts are all very good and very well structured. And as I say, they're not trying to please anybody other than the people who are holding funds with them and their employees. So I think it's probably one of the safest places to be. So I mean, for example, I have most of my pension with one organization, which is Interactive Investor. Again, I'm pretty sure it is over the 85,000. So in theory, yes, it could be at risk. However, because of the way it's structured, you know, the client accounts are all what's called ring fenced. So the assets in there can't be used by the organization. So should the admin side of the business fail, then another company would take it over and would manage the assets. I might suddenly find that the fees for managing the assets, you know, doubles, triples, quadruples, or whatever. But at that point, I would just migrate my SIP to somebody else. But the actual funds, I'm pretty happy are safe. So Jenny's asking, so to get to fire with £1 million pot over the 85k, is that at risk? Well, in a word, yes. there is a risk. However, as I've just said, the way Vanguard's managed, I personally wouldn't hesitate to have over £1 million in there. I wouldn't have a problem with that. I'd feel it was very safe. As I feel the money is safe with Interactive Investor. I don't have £1 million. I wish I did. I'm not even a quarter of the way there. But you know, hey, I'll get there eventually. So so yes, I mean, as I say, any decent organization who is managing the SIPs and the ISAs will have their client funds ring fenced. And because the SIPs and the ISAs, you are choosing what they're going into, that should be ring fenced and it should be safe. Yes, the admin part of the whole thing might go belly up, but you know, somebody will be instantly wading in there to buy them out and to take them over because it's a valuable asset. As it says on there, Alan and Katie use Halifax, and as far as I'm aware, 95% of their assets are in with Halifax. Now, given that they have got in excess of 1.6 million, and I can say that because it was published in the independent article that came out recently, you know, they are perfectly happy to leave it there, again, because someone like Halifax, they are one of the major clearing banks. And again, they ring fence the assets that clients have in the ISAs and in the SIPs because they are within other funds. Okay, so it's not like the money that's in an instant access account or a current account. The money that you put into your current account, the bank then lends out to other people. Okay, so the stuff that you put into your current account doesn't stay in the bank. They take it and they lend it to people and they make money out of it at a higher rate than they pay you. That's how they make their profits. Okay, so that money, that is the money that is at risk. So the stuff that's in your SIP and your ISA, if it's not in cash, if it's in these different funds, those funds will, well, they should have been purchased on your behalf. Okay, so it's not like the bank is holding and lending out the money. So yes, you can buy the Vanguard funds via many different providers. That's kind of what I was showing with the, we can call them Ukrainian dolls. So yeah, these little stacked dolls. Or if we want to go back to my gran, you know, it's like having your different size cake tins inside each other, all that sort of stuff. So there we go. Right. Should you go to Vanguard and take out a policy, take out an ISA or a SIP directly with Vanguard, it will then bring you to do you want to choose one of our life strategy funds and that sort of stuff? Now, what they do with the life strategy is they split it between shares, so equities, and bonds. The idea being that bonds basically de-risks your portfolio, so that they give you much more level, more stable returns, on the idea that as you get older, you might want to transfer out of shares, which are riskier, and into bonds, which are less risky. And basically that helps to level out your income as you get older. Now, the interesting situation here is, I don't know if you heard about what happened with Silicon Valley Bank, but they've gone pop, or at least the US arm has. The UK arm apparently was profitable, which is why HSBC are buying them out. But what happened is, and it's also happening with Credit Suisse, is because the interest rates have gone up and inflation has gone up so much, and this has been driven by the central banks, bond values have been decreasing. Now, what happened was Silicon Valley Bank bought up a whole load of bonds in order thinking that they would return a certain amount of interest, and then the rate of inflation has shot up, so suddenly these bonds are worth a whole lot less because they don't give such good returns, and new bonds are being issued at higher rates, so everybody wants to get rid of their low rate bonds, and that essentially is why Silicon Valley Bank has gone pop, is because, you know, they had all of these low rate bonds. So yeah, is it a good thing? It can be. I mean, if you listen to J.L. Collins, and if you listen to some of Millennial Revolution, they will talk about the sort of share bond balance. Alan and Katie are just 100% in shares. You know, let the market go where it goes and ride along with it. In terms of fund types, the index funds, as you can see here, even in Vanguard, are much lower fees on the index funds than they are on the sort of active or managed funds. You can trade some of the Vanguard funds as what are called ETFs. So if you're using someone like AJ Bell or Interactive Investor or Hargreaves Lansdown, if you go with the ETF version of the Vanguard fund, that means you can trade it instantly. Whereas if you go with the other type of fund, and I can't remember what they call it, but basically they bulk buy sort of once a day. And in that case, you're not sort of live trading on it. You can go for several different Vanguard funds, these blended ones, which are bonds and equities, pure equity, or you can opt for fixed income. Again, you know, Alan, Katie and myself, we all just stick with the equity stuff, especially as we're looking for growth. Do you want to go for a European fund, a global fund, or a UK fund? Generally, you want to diversify as much as possible. Okay, so a global fund is generally what we would always look at, so that it is involved with everywhere, all over the world, as opposed to zooming in on any one specific market or any one specific type of organization. So, you know, we would never just get funds which are in airlines or in fossil fuels or in, you know, any one particular industry, pharmaceuticals or computer components or something. Want something that's spread across everything, so that even if one part of the market is going down, another part will be coming up. The two different types of funds you can get are accumulation or income. What does that mean? Well, essentially, the difference is, as it says, what happens with the dividends. So on accumulation, it is when you are trying to grow your pot as much as possible. So any dividends that come from those companies is instantly put back into buying more stocks. Now, you don't see that on your balance as an increase in the amount of stocks and shares you hold. But what you will see, if you look at how the Vanguard Global Index accumulation has increased in value versus how the Vanguard Global Index income has increased in value, you will see that the accumulation one has increased in value by more than the income one. And the reason for that is that any dividend payments coming in the accumulation one is stuck into that pot to buy more stocks and shares. So yes, the income one, dividends will be paid out to your cash account. So that will come back to you, which is worth considering when you're coming to draw down, because if a dividend is paid out to you, that comes as part of your capital gains allowance. So you can use your tax-free capital gains allowance to kind of make a little bit of extra money on that. So, okay, Mark, nice to see you again next time, and you can catch up the rest of this when I've uploaded it to YouTube later. Thank you very much for coming. Nice to see you. So yes, there we go. Please do go to alandonegan.com. There, Alan and Katie have written loads of articles on there. They've also done YouTube videos regards opening your Vanguard account, regards how to choose your funds. You know, what is an index fund? What is what's an ESG fund and all that sort of stuff. There's loads of stuff on there. The amount of content they have created is phenomenal, and it is all really well researched and full of Katie's lovely graphs. So well worth seeing. Getting actually started. So remember those cake tins, remember those Ukrainian dolls. The first thing you need to choose is your big one. What are you going to put everything into? Choose your platform, choose your provider. Is it going to be Vanguard? Is it going to be your bank or building society? Is it going to be Interactive Investor or whoever it is? Just make sure the fees are as low as possible. Okay, so Vanguard's platform fees are extraordinarily low. If you only have a small amount invested, then Hargreaves Lansdown, again, they charge a percentage fee per year, and it is low. If you are over a certain amount, then Interactive Investor charge a fixed fee per year, which is pretty low. And AJ Bell again is quite low. So yes, it is make sure you find somewhere with low fees. Open your stocks and shares ISA or your SIP or both, you know, go for it. You know, if you've got money you can put aside, put into investments, great, go for it. Buy yourself your Vanguard index fund, or if you can't buy a Vanguard index fund because you're not in the UK or you're not in a place where Vanguard index funds are available, then please do find something that follows like the FTSE Global All Cap or the S&P 500 or another global index fund is benchmarked against it, and make sure it is closely benchmarked against it, because there are some funds which, even though they benchmark themselves against various index funds, have nowhere near the diversity that is in the true index fund. So do be careful. With Vanguard, you can either start off with a lump deposit of £500, or you can set up £100 a month direct debit. I think with Hargreaves Lansdown, that's actually reduced to £25 a month direct debit. So, you know, if you can scrape together a little bit, you can do something. And the most important thing is to pay yourself first. This is really important, is set up your direct debit to come out of your account as soon after you get your monthly your monthly paycheck as possible. There you go. Invest every single month as much as you can. Yeah. Oh yes, and of course, measure your progress every month. Do your net worth, your finance meeting over a good breakfast or a good lunch, or, you know, just whilst after playing Twister, I don't know, or just before you have that really nice bath with a, you know, your lavender bath bomb and a good book and a candle, and if you fancy it, a glass of wine or whatever else really gets you going, you know. There we go. So last little bit of advice, well, you can read that for yourself. Make sure you understand what you're doing and you are happy with it. And if you're not sure, ask questions. The Facebook group is brilliantly friendly, brilliantly full of people who have knowledge. So make use of it, please, please. And the last sort of thought is, don't focus on the outcome. Okay, don't focus on that. Oh, I need 1.2 million to be able to retire early. Yeah, that can get a bit overwhelming. I mean, I occasionally fall into the trap of thinking, oh, I want 1 million so that I can retire, and I've got nothing, you know, nowhere near that, and oh my God, I'm going to have to work and I need to do more work and this, that, and the other. And it's just, it's just too much. I can't do it. Don't stop it. Okay. Come away from focusing on that end point. Okay. Focus on the process. Focus on every month. I'm just going to take a little amount of money and I am going to put it in my investment and I'm going to forget about it. Focus on those small steps. Okay. Because those we can do. That we can do every month without fail. Whereas looking at that big picture at the end, you know, oh, I've got to build a pyramid. Yet no, you've got to move this one brick from here to here. That's all you've got to do. And you've just got to keep doing it. And then you will get there. So there we go. We come to the end. The homework. If you have not already, because of having done Alan and Katie's course, and this is just a recap. So if you haven't done it already, come on, why are you still waiting? And I appreciate some people are nervous. That's fine. You don't have to put all money in at one go. You can just do a little bit at a time, but do something. So there you go. Make sure you've got your emergency fund. Make sure you've got some living expenses as well, just in case the world does something really funny and, you know, messes up all your income sources. Once you've done that, get your big cake tin, get your medium-sized cake tin, get your small cake tin, and get baking. Hopefully that analogy works out for you. Okay, righty. Well, thank you very much for listening. I'm going to stop here because I think I have talked more than enough at you. So if I say